Good afternoon, everyone. My name is Isao Ogata, President and Representative Director of Raccoon Holdings, Inc. Allow me to start today's financial results presentation for the second quarter of the fiscal year ending April 2026. Before proceeding to the results overview, we first have a significant announcement. We will be delving into the specifics momentarily, but the headline news is that Raccoon Holdings has decided to enter into a business alliance with Advantage Partners and raise capital. Currently, we operate across a range of different businesses. In light of this, and to accelerate our growth, we have recognized a critical need to leverage advanced analytics functions and access perspectives from external experts. This prompted us to go ahead with this business alliance with Advantage Partners, coupled with the decision to raise capital. We will be reviewing the details in a moment. Looking at the summary for the second quarter of the fiscal year ending April 2026, we recorded 3.134 billion yen in net sales, which corresponds to a YOY increase of 2.7%. We recorded 574 million yen in operating income, a YOY decrease of 7.3%. 519 million yen in ordinary income, a YOY decrease of 13.4%, and lastly, 322 million yen in net income, a YOY increase of 11.5%. While top-line growth may appear somewhat anemic at first glance, this is primarily the result of an accounting artifact resulting from the sale of our rent guarantee business subsidiary, Raccoon Rent, last fiscal year. Executive Vice President of Finance Kono will provide you with a more detailed breakdown during his presentation. Two main factors impacted operating income in the second quarter. First, in the export business, we faced volatility in overseas shipping costs, which created a slight headwind. Second, we also incurred shareholder benefit costs in the second quarter. That said, these headwinds were partially offset by an improvement in the cost of sales in the financial business. All in all, our overall performance is tracking roughly in line with expectations. Let's now review our business alliance with Advantage Partners and the topic of financing. Allow me to start by outlining the purpose of this alliance. As I'm sure our long-term shareholders know, we currently provide three core services: Super Delivery, which is a B2B e-commerce platform for apparel and general merchandise; Paid, which specializes in B2B payments; and Uriho, which is an accounts receivable guarantee service. Until now, each of these had been operated as a standalone independent service. However, our aggregate client base of close to 500,000 companies that use our three services consists exclusively of SMEs. What's more, these are not merely company names on a list. Rather, every single company is an active B2B client that we have screened and to which we assigned a credit limit. We view this client base as a vital management resource. Going forward, we want to transition from our legacy model of offering isolated services to a fully integrated model. We envision a future where these 500,000 companies can freely and seamlessly access any new service we deploy. SMEs, including the 500,000 SMEs that make up our client base, are often short on management resources, making it inefficient for them to develop proprietary solutions on their own. We want to leverage rapid advances in cutting-edge technologies and tools like IT, DX, and AI to bridge this gap. Specifically, we intend to open our platform to third-party providers, inviting companies that have services that will be of value to our SME clients to join our ecosystem. To accelerate this process, we will actively consider either acquiring a partial capital stake or, in some cases, bringing these partners into our group through M&A. Until now, our decision-making has relied heavily on the intuition and experience of the founding members, such as myself and Mr. Kono. However, in light of the significant scale of our business, now is the time to prioritize a scientific, data-driven approach, grounding the decision-making process in rigorous analysis rather than on intuition. Advantage Partners boasts an exceptional track record in this area. Through numerous discussions with them, We confirmed that they do indeed possess the exact management resources needed to drive this shift. It was on this basis that we made the decision to enter this business alliance with Advantage Partners. Allow me to review the various support themes within this business alliance. Advantage Partners' primary role will be promoting M&A initiatives and assisting in the PMI process. Before this business alliance, our M&A strategy tended to be based on a reactive selection process. That is, we would evaluate incoming proposals and select the best acquisition target out of the options provided. By partnering with Advantage Partners, we can now define our strategic direction first, and then actively identify and target companies that meet our requirements. Beyond M&A, we also intend to create synergies with existing businesses by accelerating other capital and business alliances. We have executed 2 M&A transactions in the past. Of these, one didn't work as well as we had hoped, so we unfortunately ended up exiting the business, but the other was a significant success and now constitutes the backbone of Raccoon's financial business. That said, the PMI process remains a complex challenge, so we would like to leverage Advantage Partners' expertise in a way to allow us to accelerate and streamline future integrations. Second, Advantage Partners will provide support for accelerating growth in the EC business. This business continues to expand at a rapid pace, not only in Japan, but also in the overseas segment. Note that we are basically charting new territory with our B2B cross-border e-commerce service, since very few players operate in this market segment. It is precisely due to the trailblazing nature of our efforts in this market segment that our corporate decision-making must be grounded in rigorous research and solid evidence. This applies to marketing and advertising as well. Third, Advantage Partners will provide support for accelerating growth in the financial business. Specifically, we anticipate unlocking significant value by strengthening our marketing and advertising activities and establishing a robust sales organization targeting large enterprise clients. Lastly, Advantage Partners will provide support for advancing management control. Within this scope, we aim to implement a company-wide strategy incorporating portfolio management. Through our discussions, I recognized a distinct strength in Advantage Partners, namely an abundance of talent with consulting rigor and MBA knowledge. In contrast, Raccoon was founded as a startup, so our strength is rooted in teamwork and organizational unity. In light of this, through this business alliance, we can complement our current capabilities. We also anticipate that this alliance will give rise to a new environment that facilitates the acquisition of new talent profiles, such as mid-career professionals who may not have considered us previously. Advantage Partners will also provide support in these mid-career recruitment efforts. Moving on to a detailed overview of the financing agreement. We are raising funds through 2 instruments, 2 billion yen in convertible bonds with share acquisition rights, and approximately 3 billion yen in share acquisition rights. The CBs have a maturity of 5 years, with a conversion exercise period spanning between June 2026 and November 2030, and a conversion exercise price set at 645 yen. Lastly, the coupon on the CBs is 0%, and the LOT is Advantage Partners. Let's now review the use of the proceeds. We have earmarked approximately 3 billion yen for business expansion through M&A and other initiatives. Here, we will focus on M&A aimed at strengthening the EC and financial businesses. Furthermore, we aim to use M&A to expand our B2B network, bringing in participating companies that can offer valuable services to our client base of 500,000 SMEs. Second, we have allocated 1.5 billion yen toward advertising and sales promotion expenses for business expansion. Within this scope, we'll mainly focus on advertising and promotional investments for acquiring member retailers, toward accelerating growth in the EC business. Similarly, we will deploy capital with a main focus on advertising expenses for acquiring member companies toward accelerating growth in the financial business. Lastly, we will allocate just under 500 million yen to personnel and development expenses for business expansion. Here, we will focus on personnel and development expenses for strengthening management departments and businesses toward advancing management control. We need to secure high-level talent to act as the brain trust of our operations, so these funds have been designated for this purpose and for development purposes. This concludes my presentation. Before I begin, I must first note one correction. We apologize for the confusion, but the conversion and exercise period for the CBs ends in December 2030, not November. The period is therefore effectively 1 month longer. We once again apologize for the discrepancy and correct it for the record. Allow me to add a few additional remarks of my own. Raccoon has operated the EC and financial businesses for a long time. Investors frequently tell us that they find our business model itself highly compelling and value its potential. That said, and in the spirit of self-reflection, another common piece of feedback from investors is that our growth rate leaves a bit to be desired, and that we are leaving quite a lot of value on the table. In other words, Raccoon isn't living up to its true potential, and we are acutely aware of this sentiment. To address this, we announced Raccoon B2B Network within the new midterm management plan. As President Ogata mentioned, we hold a massive asset, namely our client base consisting of 500,000 SMEs. We have not sufficiently capitalized on cross-selling opportunities within this base. And additionally, there's also an endless number of companies looking to sell products and services to our retailer SME customers. The purpose behind the Raccoon B2B network is therefore to aggregate these providers, both from within our group and from outside, to offer products and services directly to our existing and future clients. We expect this initiative to significantly boost our growth rate and overall expansion, which investors have expressed some frustration with. We are humbled to recognize that some operational aspects of our company are lacking, namely in the areas of KPI management and M&A expertise. Regarding the latter, as our business grows, we start to face capital constraints. This is how we crossed paths with Advantage Partners during our search for a partner with the ability to address our funding needs and expertise gaps. The financing mechanisms involve shareholder dilution, so we acknowledge this as a potential source of concern for shareholders. However, over the medium to long term, we have full confidence that this strategic initiative will bear fruit and lead to an improvement in our growth rate. In light of this, we ask for your understanding on this front. For the sake of brevity, and given the significant time we have already dedicated to the alliance announcement, allow me to succinctly review Raccoon's financial results in the second quarter. Please refer to the presentation materials at your convenience for the standard details and disclosures. As President Ogata mentioned, we recorded 3.134 billion yen in net sales, which corresponds to a YoY increase of 2.7%. Please note that the results for the equivalent period in the fiscal year ended April 2025 included revenue from the rent guarantee business, which we sold in December. In other words, the underlying YoY growth rate is actually 9.8%, since one must adjust for this accounting artifact. While we fell slightly short of the double-digit mark, our underlying growth rate tracked in line with initial company projections. We are seeing strength in both the financial and EC segments. That said, within the financial business, the GMV growth rate for paid unfortunately came in below our expectations. While we benefited from positive drivers, specifically a higher take rate and very strong active customer numbers, new large enterprise accounts are taking longer than expected to contribute to GMV. As President Ogata mentioned earlier, the acquisition of large enterprise accounts for paid is an area we intend to strengthen by leveraging the capital and expertise gained through our alliance with Advantage Partners. Let's now review the results in the EC business, which delivered a very strong performance in the domestic market in Japan. As noted in recent quarters, average sales per buying customer showed signs of bottoming out after a protracted downward trend following a change to our pricing structure back in 2023. I am pleased to report that, as of the end of the second quarter, average sales per buying customer is now finally past the inflection point and has staged a turnaround to positive growth. This important milestone, coupled with a stable increase in the number of buying customers, drove GMV growth in excess of our expectations in the domestic segment. Looking at the overseas EC segment, while average sales per buying customer surged during the period under review, we faced tariff-related headwinds in the United States and continued sluggishness in the Hong Kong market. These headwinds led to a decrease in the number of buying customers in these two regions. This restricted overseas GMV growth, which unfortunately only grew by 6%. We recorded 574 million yen in operating income, which corresponds to a YOY decrease of 7.3%. While a profit decline is an understandable cause for concern, the catalysts are clear and specific. First, significantly lower default rates in the financial business allowed us to revise our allowance ratios. This resulted in the cost of sales ratio falling to an exceptionally low 20.2%, down from the typical 25%, and provided a notable boost to margins. Better margins, in turn, drive profitability. Concurrently, two headwinds contributed to this YOY operating income decline. First, we allocated 46 million yen for shareholder benefit costs in the second quarter, as part of our new shareholder benefit program, which we started this fiscal year. That said, these costs track closely in line with company guidance, so there weren't any major surprises on this front. In light of this, the main reason behind the decrease in operating income was a spike in overseas shipping costs. As I mentioned last time, we suffered the negative effects of a tariff-related spike in overseas shipping costs in the first quarter. We recorded a logistics overrun of 31 million yen in the first quarter, but then made good progress in the months of August and September in reducing this number. Despite this initial improvement, we were hit with yet another unexpected situation in October. Specifically, tariff-related issues caused the suspension of US-bound sea freight, forcing us to use expensive air freight and incur just under 10 billion yen in unforeseen costs in October. All in all, we recorded approximately 30 million yen and 20 million yen in cost overruns in the first and second quarters, respectively. In summary, we were expecting a large improvement in the second quarter, but this recovery did not materialize as planned. Once again, in the interest of time, allow me to provide a condensed overview of the financial results. As we saw earlier, we recorded 3.134 billion yen in consolidated net sales, 2.601 billion yen in gross profit, and 574 million yen in operating income. To reiterate, we initiated a shareholder benefit program this fiscal year, so a meaningful YOY comparison requires an adjustment corresponding to the expense amounts for this program, which total 46 million yen. After this adjustment, our underlying operating income growth was 0.1% on a YOY basis, meaning this metric was virtually flat for the period under review. We were expecting stronger growth, but the aforementioned 50 million yen in additional logistics costs incurred across the first and second quarters dampened our results. Our core operating income, excluding advertising and sales promotion expenses, decreased by 1.1% YOY. As the charts indicate, Group GMV grew steadily, while we also succeeded in significantly growing Uriho's guarantee balance in the second quarter. Looking at the consolidated net sales trend through the first half, the financial business saw a slight decline, while the EC business demonstrated strong growth. As previously noted, the organic underlying growth rate was 9.8% after adjusting for the sale of the rent guarantee business. The quarterly trend in net sales continues showing strength. Gross profit saw a substantial increase in the second quarter, primarily driven by better margins resulting from a reduction in default rates in the financial business. The EC segment also saw a slight gross profit improvement. SG&A expenses were the primary factor behind the decline in operating income in the second quarter, as we posted very strong net sales and gross profit results. However, cost factors in the SG&A line acted as a drag on final profitability. Shipping costs and expenses associated with shareholder benefits are included in the Navy section, which corresponds to the other category. This total of 537 million yen includes 46 million yen in shareholder benefits and 50 million yen in shipping cost overruns. In summary, these specific cost increases totaled just under 100 million yen and were a significant factor behind the profit decline in the second quarter. On a YY basis, operating income decreased from 619 million yen to 574 million yen. However, adjusting for advertising and sales promotion expenses, the decline in underlying operating income was actually less pronounced. The graphs show the quarterly trends in operating income. As you can see, operating profit results actually increased slightly compared to the first quarter, indicating a recovery trend. Next is a summary by segment, starting with the EC business. Net sales grew by 6.8% YOY in the EC business, while segment profit decreased slightly by 0.8%. We incurred 50 million yen in unexpected shipping costs in the first and second quarters. Naturally, this doesn't change the fact that our actual results were negatively impacted by higher shipping costs in the wake of the US tariffs. But if we were to add back this one-off cost, our underlying segment profit is somewhere in the vicinity of 630 million yen. The numbers underscore just how deeply frustrating it is that external factors conspired to prevent us from living up to our true potential. It is unfortunate, but we must accept second quarter results as they stand. We recorded 14.475 billion yen in total EC GMV, an increase of 8.6%. While this falls slightly short of our full-year target of 10.8%, the breakdown tells a mixed story. Specifically, we recorded 10.453 billion yen in domestic GMV, which corresponds to an increase of 9.7% and is tracking slightly ahead of our full-year target. We recorded 4.022 billion yen in overseas GMV, which corresponds to an increase of 6%. This fell short of the 14.5% target due to the headwinds previously discussed. The section in the upper right-hand corner contains a results summary for this business, but we will be delving into the details more deeply in later pages, so allow me to skip this section. The waterfall chart compares second quarter operating income results on a YOY basis. The single most significant negative factor is the other category within SG&A. Of the 66 million yen increase in this category, approximately 50 million yen is attributable to the surge in shipping costs, so this single factor was a significant drag on our segment profitability. We recorded a 9.2% increase in buying customers and a 0.2% increase in average sales per buying customer. These two factors combined resulted in a domestic GMV of 5.16 billion yen, which corresponds to a 9.4% increase. The table on the right shows the YOY trend for average sales per buying customer. As you can see, the first quarter of fiscal year 2025 was marked by a significant decline of 15.5%. Since then, the rate of decline has narrowed with each passing quarter, improving to negative 8.7%, negative 1.8%, negative 8.5%, and negative 1.3%, finally turning positive in the second quarter and marking a definitive turnaround in this metric. Our initiatives remain consistent with our strategy in the first quarter. Specifically, customers acquired organically tend to have a significantly higher LTV, so we continue enhancing our SEO strategy in order to drive organic traffic to our platform. Naturally, advertising spend tends to grow as our GMV itself grows, but our goal here is to actually decouple the two metrics to the greatest extent feasible. In other words, we aim to improve our operating profit margin by preventing costs from rising linearly with sales. To this end, we will be redoubling our efforts to drive organic traffic to our platform. Moving on to international EC, the number of buying customers declined by 6.6% due to headwinds in the US and Hong Kong. Conversely, Average sales per buying customer surged by 14.6%, reaching 327,152 yen across all countries. To put this into perspective, this is more than double the domestic average of roughly 160,000 yen. This underscores the fact that our overseas transactions generate significantly higher value per order. Notably, while the customer count is down in the US, average sales per buying customer have grown substantially and now exceed 500,000 yen. Results in South Korea remain steady. We are now directing advertising resources toward the EU and Australia, and also Asia. This strategy is bearing fruit, as we are seeing significant growth in countries and regions outside our traditional top 4 markets of Taiwan, the United States, Hong Kong, and South Korea. Notably, our results in France grew by 92.8%. As you can see, the overseas segment continues driving the value of transactions per customer, which surged in the second quarter. On the other hand, the value of transactions per customer for domestic retailers, which account for the largest portion of our GMV, appears more or less flat. However, closer inspection reveals that this category actually registered a slight increase compared to the second quarter of last year, so this is something that gives us confidence going forward. Segment profit results in the first and second quarters tracked the results for the equivalent period last fiscal year in the EC business, as shipping costs weighed on results. That said, we have been continuously optimizing our logistics. Case in point, already in August and September, prior to the unexpected suspension of sea freight in October, cost overruns had shrunk to negligible levels. As such, we are confident that the impact of shipping costs will meaningfully diminish in the third and fourth quarters. Let's now look at the summary for the financial business. We recorded 1.293 billion yen in net sales, a YOY decrease of 2.6%, and 402 million yen in segment profit, a YOY increase of 7.2%. To reiterate, segment sales here are down due to the sale of the rent guarantee business in the second quarter of the April 2025 fiscal year. Excluding the effects of this accounting artifact, the underlying sales growth rate stood at 14.4%, representing double-digit organic growth. Net sales grew by 15.8% for paid and by 13.5% for Uriho, as both services achieved double-digit growth. However, looking at the KPIs, while these businesses performed relatively well, both paid and Uriho unfortunately fell slightly short of their full-year targets in terms of GMV and the guarantee balance, respectively. We posted a strong segment profit performance. Notice the figure of 122 million yen in the waterfall chart. This represents the YOY increase in combined gross profit for paid and Uriho. The aforementioned double-digit sales growth and a lower cost of sales boosted gross profit by 122 million yen in the first half of the fiscal year. External transaction volume is as shown here. As I mentioned at the beginning, Uriho's guarantee balance expanded significantly. The subscription-based portion of the guarantee balance continues showing robust growth. The non-subscription portion also recorded a high growth rate of 10% in the second quarter. This growth from the non-subscription side successfully boosted Uriho's overall guarantee balance baseline. After accounting for the sale of the rent guarantee business, indicated by the lighter shaded section on the chart, quarterly sales demonstrate a consistent upward trajectory. Circling back to what I said earlier, default rates remain exceptionally low. Historically, default costs consume about 25% of what we collect in guarantee fees. However, we revised our allowance ratios in the second quarter, resulting in a significantly improved ratio of 20.2%. Lastly, we have the segment profit results for the financial business. Although sales fell slightly short of expectations, the combination of double-digit growth and lower cost of sales resulted in a new record for segment profit. We recorded 221 million yen in segment profit over the 3 months that make up the second quarter. Lastly, operating income, excluding advertising and sales promotion expenses, came in at 287 million yen, which also represents a record high. This concludes today's presentation.